Okay. Norwegian Cruise Line Holdings, NCLH. They just dropped their Q3 2025 numbers. Record total revenue, $2.9 billion, beat their own earnings guidance.
Yep.
And yet the stock just plummets, down over 14% right after the announcement.
It's quite the head-scratcher on the surface.
Right. So let's unpack this. What exactly did investors want that NCLH didn't deliver, even with these record results?
Well, it really boils down to expectations versus execution. NCLH actually executed pretty well against what they guided for.
Okay.
But the market, the analysts, they seem stuck on those really high growth rates we saw right after the pandemic rebound.
Yeah.
So even record numbers weren't quite enough this time, especially on one key metric, net yield.
Okay, before we get deep into net yield and the market reaction, let's just quickly nail down how strong Q3 actually looked on paper. You said record revenue, $2.9 billion.
That's right. A solid 5% increase compared to Q3 last year, 2024.
And it wasn't just the top line, was it?
No, absolutely not. The bottom line was strong, too. Adjusted EPS, earnings per share, came in at $1.20. That actually beat their own guidance, which was $1.14.
Wow, okay. That's a 17% jump year over year.
Exactly. And adjusted EBITDA, another key profitability measure, was $1.019 billion, also slightly ahead of their guidance.
And the ships themselves, packed.
Oh, yeah. Occupancy or load factor hit 106.4%. They were guiding for about 105.5%, so they beat that too.
So ships are full, they beat their own earnings target, delivered record revenue. I mean, usually that screams confidence, not a 14% stock drop.
And this is where we hit that disconnect, that analyst gap. The stock dropped because even though $2.94 billion is a record, it missed the average analyst expectation.
Ah, okay. What were analysts looking for?
They were looking for something closer to $3.02 billion. So NCLH missed by about, what, $80 million?
Doesn't sound like that much on nearly $3 billion.
In the grand scheme, maybe not. But in this sector, which is super sensitive right now, especially post-COVID,
Yeah,
even a relatively small miss like that can trigger a big reaction.
And you mentioned net yield earlier. That seemed to be the real sticking point.
I think so. Net yield, that's basically the adjusted revenue they make per passenger per day, right? It's seen as a key indicator of pricing power.
And how did that look?
Well, it increased 1.5% on a constant currency basis. Now, that was right in line with NCLH's own guidance.
So they did exactly what they said they would do on that metric.
Precisely. But here's the crucial bit. The market isn't really grading them against today's travel reality. It feels like they're still grading against that, fantasy post-pandemic period where prices were surging like crazy.
Right, that couldn't last forever.
Exactly.
Yeah.
So just being in line with guidance, delivering only 1.5% growth there, it just signaled to investors that maybe NCLH's pricing power is cooling off faster than they'd hoped.
That's tough. Getting punished for hitting your own targets. So if the market's demanding faster growth, higher yields, what's NCLH's game plan now? The CEO, Harry Sommer, mentioned demand is still strong into 2026.
Yeah, demand seems healthy. The big strategic story, though, is this deliberate shift by the main Norwegian cruise line brand towards what they're calling premium families.
Premium families. Okay, what does that mean in practice? More water slides.
Well, maybe partly.
Yeah.
But it's more about strategic deployment. They're shifting more capacity, more ships, toward Caribbean routes that are specifically designed to attract this group. It's seen as a high-spending growth engine.
Ah, I see. So it's about the cabin math, getting more people into one room.
That's a big part of it, yeah. The economics just work better. You get 3 or 4 people in a cabin. Even if the kids pay a bit less, it often brings in more profit per cabin than just 2 adults.
Makes sense.
But it's not just the fare revenue. The real kicker, they believe, is the onboard spending.
Right, because families, especially premium ones, are likely buying more extras. Excursions, drink packages for everyone, specialty dining.
Exactly that. You sell 4 excursion spots instead of 2. Maybe a drink package covering 4 people. All those extra cost things, they add up fast. They drive significant incremental revenue.
And you can see them investing in this.
Definitely. Look at their private island, Great Stirrup Cay. They're opening a brand new water park. Great tides, just in time for the holidays. That's a big capital investment aimed squarely at attracting and, importantly, keeping families spending on their property.
Okay, that sounds like a clear strategy to boost revenue per guest, but isn't there a risk? What about the couples or older travelers who maybe don't want a ship full of kids and water parks?
That's definitely the balancing act, and that's where the portfolio approach comes in. While the Norwegian brand chases the premium family,
The other brands cater to different tastes.
right, you've got Oceania Cruises, which is luxury, and Region 7 Seas Cruises, which is ultra luxury. They continue to focus on that high-margin adult market that prioritizes experiences. And demand for luxury travel, especially experiences over things, is still really strong.
And are those luxury brands innovating too?
They are. Oceania just rolled out its Your World Included program. It gives guests more choice. They can pick things like credit for shore excursions or maybe complimentary wine and beer with dinner. It's about offering that customizable luxury feel.
Gotcha. And to kind of tie all these different brands and strategies together, they're doing something with loyalty programs.
Yes, and this is actually quite a smart long-term move, I think. Starting October 15th, they launched a new loyalty status honoring program.
Okay, what does that do?
It basically means your loyalty status on one brand gets recognized across the others. So if you're a high-tier member in Norwegian's Latitudes Rewards, you'll get similar recognition and perks if you decide to try an Oceania or Regent cruise.
Ah, so it makes it easier for customers to move between the brands, maybe move up the portfolio over time.
Exactly. Reduces friction, encourages retention. If someone's income grows, they might naturally move from Norwegian to Oceania, and this makes that transition smoother and more appealing.
Okay, so strategic focus on higher spending families for the main brand, keeping the luxury ends strong, and tying it all together with unified loyalty. That makes sense operationally. But none of it matters if the finances aren't solid, right? Especially with the debt load from the pandemic. Let's talk about their forward guidance and what they're doing with the balance sheet.
Right. So despite that Q3 revenue miss against analysts' hopes, the company actually showed some confidence. They raised their full-year 2025 guidance for adjusted EPS
Oh, really? To what?
up to $2.10 from $2.05 previously. That signal they must be pretty confident about Q4 performance.
Interesting. And overall profitability, the EBITDA.
They kept the full-year adjusted EBITDA guidance the same at $2.72 billion. But the really interesting part, for investors maybe worried about debt, is what they did with their capital structure back in September.
What happened there?
Well, two key things. First, they actually bought back some stock, reduced the number of shares out there by about 38 million, or 7.5%. That helps boost future earnings per share.
Okay, shareholder friendly.
Right. But maybe more importantly, they refinanced about $2 billion worth of debt.
And the significance of that was?
The really key outcome, which the CFO highlighted, was eliminating all their secured notes.
Okay, translate that for us non-CFOs. Why is swapping secured for unsecured debt a big deal?
Think of it like this. Secured debt is like a mortgage on your house. The lender has a claim on a specific asset, like the ships themselves, if things go wrong. Unsecured debt is more like a credit card. The lender trusts your overall ability to repay based on your cash flow without needing specific collateral.
Okay. So it's a vote of confidence from the lenders.
A huge one. Swapping $1.8 billion of that secured debt for unsecured debt shows that creditors trust NCLH's financial health and cash generation enough not to need the ships pledged anymore. It cleans up the balance sheet, gives them more flexibility.
And they'll need that flexibility because they're not just sitting still, are they? They're planning to grow the fleet significantly.
Oh yeah, aggressively.
Huh.
They're planning to add 13 more ships across all three brands between now and 2036. That's over 38,000 new berths.
13 ships. That's massive investment.
It is. We're talking serious capital. Their new build and growth spending is projected at around $2.7 billion for each of 2025 and 2026. So they're definitely charting an aggressive growth course.
Which brings us to the really interesting part, I think. All these moves, the family focus, the luxury stuff, fixing the balance sheet, it's all aimed at hitting those big 2026 targets they've laid out. They're charting the course plan.
Absolutely. Those 2026 targets are the benchmark they've set. They're aiming for an adjusted operational EBITDA margin of around 39%.
Which would be getting back towards historical highs.
Exactly. And adjusted EPS around $2.45. It's a huge promise to the market, requires continuous improvement.
But given how sensitive the market just showed itself to be on net yield, and with all this money going into new ships, the pressure must be immense.
It really is, and it raises that critical question. Can this pivot to premium families, combined with the cleaner balance sheet, actually generate enough organic EBITDA growth fast enough? Fast enough to please those growth-hungry investors and hit their other target.
Which is the debt target, right?
Leverage. Yeah, they promised to get net leverage down to the mid-4x range by the end of 2026, trying to manage $2.7 billion a year in ship spending while also deleveraging that quickly. Well, let's just say the margin for error is pretty slim. It's going to be a real test of execution.
So they're really threading the needle here, investing billions for the future while needing to deliver growth today.
That sums it up perfectly.
So the final thought for you listening, think about that trade-off. Does the potential for higher onboard spending from these premium families ultimately outweigh the challenge of keeping that net yield growing at the pace the market seems to demand? Especially when you're adding all this new capacity, 13 new ships that you have to fill profitably. That balance between volume and yield, that's really going to define NCLH's story through 2026.